Welcome to the Finance Geeks podcast with Paul Cleworth and Warren Shute. Two financial planners shoot the breeze while sharing tips for making the most of your money and living your best life. Remember to follow, like, and subscribe to the show. And now over to the geeks in the studio.
But they are not in the studio. They are geeks in their own office. Hello and welcome to episode 9 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute and I'm here joined by
Paul Cleworth.
Today we're going to be talking about Tandem's 12 golden rules of investing. So before we jump into that, Paul, tell me what you've been up to.
I've been up to the usual, gardening, kids, dog walking, karting, that sort of stuff.
You said gardening. What you really mean is sitting on your ride-on, going around the...
Yeah, but I got the strummer out. I got the strummer out last weekend. It's brilliant fun. It's brilliant fun.
I disagree with the word fun, but
you need to get the face guard on and some boots. Yeah, I've also got the big headphones as well, and I put my little headphones inside listening to music, and then I've got, as I said, the big face guard because you don't want something, big stone coming up and smashing you in the face. But you end up if you wear short socks, and hey, listen, if you don't wear boots, everything just flips from the tree into your legs. Yeah. So you got to watch that.
Yeah, you do.
I've not got my chainsaw out yet, though. I've not got my pole saw out to take off some branches. I'm very excited about that.
Isn't it interesting? Some people love stuff like that. Gardening. My wife loves being in the garden. It's just not my thing. It's just not my thing.
What's your thing? What's your thing?
I love people. I love talking to people. I love sitting around having a chat and understanding people. I love asking great questions and things. But posh around. My wife loves being in the garden. Yeah,
so socializing.
Yeah. I find people and life fascinating.
But no manual labour.
I gotta say,
nothing difficult. No elbow grease. Yeah, no, if it's difficult,
not really. Yeah,
it's
not
sedentary
not
lifestyle.
Physical. Yeah, I think so. It's terrible, isn't it? I feel awful saying that. So, bit of gardening. Anything else?
Yes, just last weekend I went to Royal Albert Hall to the film gala.
Nice.
It was tremendous. It was So it took 6 clients of ours, which is brilliant. So there was Stephen Bell's the conductor. There's the Royal Philharmonic Orchestra, of course. And then there was a presenter, Petrok Trelani. I've seen him before. He's only about 50.
I hope you pronounced that right.
I don't think I have, but he's actually very, very good. So it was the usual John Williams, Hans Zimmer, Ennio Morricone, John Barry. I mean, amazing composers. And then because I'm a big film buff, you're listening to the theme tunes from Batman, Superman, Gladiator, Star Wars, Lord of the Rings, that sort of stuff. So it was absolutely tremendous. And the acoustics in the Royal Albert Hall, as I'm sure you know because you've been, are amazing, aren't they?
So, favourite piece?
The favourite piece for me, the best piece, was when one of the violinists played the sort of chief violinist, if you like, whatever you call him. He played the theme from Schindler's List, and it was very, very moving because it was largely him. And that's now, I think that's 1999 or something. It's quite an old film now. It's like 25 years old.
Yeah, great film. Very moving film.
Yeah. But it's made me want to buy on DVD or Blu-ray because I used to collect Blu-rays and now everybody just watches stuff on Netflix and Amazon and all that. So I've kept all of mine, but I've bought some that I didn't have, like Squadron 633 and bought E.T. I bought E.T.
Bought E.T., yeah.
Yeah, because it's a classic, 1982, and I want to show my kids.
I had such a big thing for Drew Barrymore when I was growing up. There you go. That's a confession.
Okay, so listen, what have you been up to?
Take that. So my wife
take
and
what?
I
take what?
Take that.
Take what?
I was such a big Take That fan when I was growing up. I absolutely loved them. Great music.
Who's your favourite? Who's your favourite in there? Gary?
No. I didn't actually have a favourite. I think Gary is incredibly talented.
He writes all the songs, doesn't he?
He's a genius. He really is a genius and such a nice guy, so humble. So I really, really like him. I liked Robbie in the day as well. I thought he was, he's also very, very talented, but in a different way. But just like their music, I don't really sort of fess over them. I like their old stuff as well because it has an association for me of growing up when I was younger. And
now do you model your beard on Gary Barlow's? Is that what it is?
Gary? No, I don't. I probably should. He's not a bad looking guy. He's got into good shape, so that's not a bad little punt. Maybe I'll do that.
And do you not miss Robbie? They didn't have Robbie there, did they? When did he leave the band? Can't remember.
A long time ago. Yeah, a long time ago. I think he was in. I saw them a number of years ago in Cardiff, and I think the 5 of them were there. But the other week at the O2, it was just the 3 of them: Mark, Howard, and Gary. And it was good. Yeah. My voice been very, very croak, singing top of my voice. Had a good time. Yeah. Had a
Tremendous.
really good time.
Do you know what else I've been doing recently? I've been solving problems. Right. So work
Ominous.
stuff. Yeah, it is. But I've been thinking deeply recently, right? Because we all got problems to solve. And I think the job of a financial planner largely is to help people solve problems or help people make smart decisions. So the usual things that need to get done, whether it's, I need, my car's broken, or, I need some new fencing, or I need to have a meeting with a member of staff, but lots and lots of stuff. And it's made me realize that life's just a game, and that, you've just got to learn to play the game. So you don't overthink stuff, and just, if you treat it and don't overthink it, don't overanalyze, it does help you. The better you get at trying this stuff and make, solving problems, the more confident you get. So it's and I think that if you don't know something, just ask. And I have bouts of confidence, really confident most of the time, and then doubts, and sometimes doubts. But I had a lovely meeting last week with a client where he was asking for my opinion on stuff, and there was things that I was telling him that I just thought he knew, and he didn't. And I followed it up with a nice email, and I sort of gave lots of web links and said, how about this, how about that? But it's because of the experience I'd had working with lots of other clients, and he was starting a new business, so I said, here's some websites, and have you thought about this, and this? So, it was fascinating.
I completely agree. If you're a listener and you're a DIY financial planner, DIY investor, I take my hat off to you. I really do, genuinely. And I don't think everyone needs a financial planner in their life, but I think the value add, one of the primary value adds we give is that we sit in front of clients virtually every single day of the year. And we have done for 20 plus years. And we don't always share our own experience. We share the experience of all of our clients as well. So it's an exponential compounding effect of our knowledge. We don't know everything, but we know the collective information of all of our clients. So, I completely agree with that. Okay, Paul, let's, what's our main focal point for today?
So today we're going to talk about the 12 rules of investing.
12 golden rules.
12 golden rules of investing. And I decided to put these together when I was developing our investment system at Tandem, which is called Trails, the Tandem Risk Assessed Investment Levels. And I thought it would be useful to put these, what I consider rules together, having to try and educate people about things that you need to consider when you invest money. So the idea is we'll go through them and talk them through and see what you think of them, because I don't know if you've seen them all before or heard them before.
Sure. Okay. So what's the first rule?
So the first rule is work out what you actually want to achieve from your investments and define the time frame.
Now, I get a bit of stick on this show about often saying know your outcome. Okay, so I'm kind of know your outcome. So rule number one really is know your outcome. Is that fair?
Well, I didn't phrase it quite like that. Yeah, no. But it is deciding whether you want income or capital. How long you've got to invest your monies. And it does come back to deciding what you want. I mean, if you're trying to reach a destination or reach a point in the future where you've got enough money, you have to determine when that is. How far away it is. Is it 10 years? Is it 20 years? And how much do you need? And you have to start with the end in mind.
It's like Stephen Covey. Absolutely, start with the end in mind. I completely agree with that. And I also think so many people underestimate their time horizon. So a client might come in to see me and start talking about their investment plan, and they might think of retirement, whatever that might be. So for some people, it's a number. Some people, it's a date. They'll think of retirement as their end game. But really, if we're retiring in our 60s, it's very probable we will live into our 90s. My dad's 99 at the moment. But I would even push it further than that and say it's very likely you're not going to spend all of your capital, and therefore your time horizon should arguably be your children's or your grandchildren's dates of birth. So, pushing our time horizon out into the future, having a longer time horizon allows us to accept more equity exposure in that. But yeah, completely agree with that. And first thing I start with my client, I still say to them, how do you want to live the rest of your life? What does it look like? And that's from a financial planning perspective rather than investment, because I think these investments underpin our financial plan. Okay, number two. What's number two?
So number two is find your risk profile and take into consideration your age, how long you want to invest, and your needs. So let's just review. We talked about risk in a previous podcast, but when it means find your risk profile, What does it mean to you, and how would you explain that to your clients?
Yeah. So we really want clients to say anything they need access to in the next 5 years really needs to be in cash or cash equivalent. Okay, national savings, something along those lines. Anything longer than that, it depends on what the outcome of that money is for. So if their outcome is to grow that money, which most people is, rather than preservation, we really need to take equity exposure. So we need to get a globally diversified portfolio. And what I mean by that is 100% globally diversified portfolio, not a 60-40. Now, for some people, the volatility, which basically means the flow, the ups and downs of that portfolio is too great. Typically around about 15% or so in a year. In extreme time, it might be 50%. So if those fluctuations are too great, then we might dilute it down with some fixed income. But we really would rather educate and explain to our client the downside of doing that, because their biggest risk really is not having enough money.
I had an email from a client just this week, and she's late 60s. She's looked at a portfolio recently, and like everyone who's got a high level of global equities, they will have seen about a 15% increase in the last 6 months. And she's going, "Oh, that's good. I was pleasantly surprised." And then it went on to say, "What can I do now to sort of lock in that gain and make sure there's no further risk, and to make sure I sort of preserve the buying power of my money?" And she was basically saying, "I don't want it to go down," and suggesting almost with her wording that, "Oh, just put it all in cash or some other product." And I've got to now go back and re-educate that client and say, well, actually, you've got to stay in global equities, because if you're going to live another 20, 30, 40 years, you need the power of growth, the power of global markets and capital markets to actually work for you. And there's this perception that if you invest money that, that if it goes down, you lose money. And that's only the case if you sell out, if you capitulate, if you realize the gain. It's just trying to accept the fact that markets will be volatile, but long term they'll go up. And don't try not to look at it too often, and realize that if you've got 100 grand or 1 million or 10 million, if you're only drawing an income from it, it doesn't matter. If you're drawing, a reasonable level of income, 4 or 5% from it, and the markets fall, your pot isn't going to sort of run out. So if you need access to capital, put that money in cash. 3 to 5 years of income, and that's just the golden rule. There you go. We don't need more than 2. Done.
No, I agree. And I kind of perceive my role is not trying to get our clients an outstanding return from the markets, but just trying to keep our clients in the market. Does that make sense?
Definitely.
So, I'm not trying to get my clients to get a great return. I know with confidence that return will come if the client stays in their seat and just allows it. But, the argument of, crystallizing that gain is, well, why do you think it's not going to rise in the future another 15%? Get on it. Don't leave it any more time, Paul. You shouldn't be doing this podcast. Get speaking to a client. What's number 3?
Number 3 is agree your end goal and work backward from that place in a planned and disciplined manner. And this is to do with the planning process. So just explain to our listeners, what would that means to you?
Yeah, so one of our opening questions to a client is really along the lines of, how would you like to live the rest of your life? If you knew you couldn't fail, what is it you would do? So we start from a planning perspective rather than an investment side of things. Investment is kind of a logical process. The planning is very artistic. So they start describing their life, what they might want to do, and they don't necessarily know at that stage what it is. So we develop a financial plan, which is articulate as a cash flow. So it's a chart. And then during the meeting, we will then start having the conversations. And when they realize often that they have more money than they need and that they can retire earlier, that's when the dynamic planning process comes in place. So really starting with the end goal is that journey. And it really doesn't finish ever, the end goal, because clients often, and like I do, change our mind. We might have our outcome to say, I do want to retire early. But once you know you can retire, once you know you can stop working, your mindset changes, and all of a sudden you go to work a bit lighter and you enjoy work a little bit more, or you take a different role.
This rule gives credence to the notion that you absolutely need to have a plan, though. You need to sort of look and decide how much am I earning now, and realistically, at what point in the future do I want to become financially independent? Not necessarily retire, and that's relative. So if one is earning $5,000 a month now, maybe it's 3,000, 60% in real terms in the future. And you can do the math to say this is what you need to do to achieve that goal. But over the years, as you say, the goalposts can change. You can change your mind, but it's not losing sight of that point. And then you've got to realize it. You've got to realize that this is the point. I've been planning all along. Am I going to stop work? Am I going to do something else with my life? And transitioning from working to not working is a big thing that an advisor will help the client do.
The biggest thing that sort of shocks me, and it's the number one thing I do with my coaching clients, when I coach financial planners, the number one thing I get them to do is to do their own plan. The number of times I will go into a group of financial advisors and say, hey, who's got a financial plan? And maybe 10, 20% of the audience put their hand up, maybe 30. And then when I ask them, who knows what their number is, that's even like 1 or 2 people. It's crazy. It's crazy.
But okay. Right. Rule number 4. Understand that effective investing is a long-term solution. Ideally think in terms of at least 10 years.
Yeah, I completely agree with that. It's effective investing isn't speculating. It isn't trying to buy the next hot thing. It isn't trying to buy the next new crypto or ETF or whatever it might be. It's buying a globally diversified portfolio and just holding on to it as long as you can. And arguably, investing is very boring, and that's why most people don't succeed at it. But
okay, I agree with you. And trying to make it a little bit more interesting and trying to make it more visual. You said there it's not speculating. I agree. It's not the latest thing. It's not 5 or 10 individual companies. It's also not the same as saving, which is cash. And we're certainly not gambling with clients' money. So investing is a allocating your money in a sort of systematic way to gain a return better than cash and better than inflation. And setting a realistic level of expectation in terms of a return. So we project at 6% net of charges, but we can and have achieved between 7 and 9.5%, for a lot of our 60-40 upward models. But when you consider that a globally diversified portfolio of equities, as per market cap, has got like 12 to 15,000 stocks in it, you are holding all the big companies of the world that your Amazons, your Googles, your Microsofts, your Visas, your Teslas, all in there. So you can get excited to know that people buy products, people buy goods, and you're participating by being an owner of that stock, albeit inside a unit trust, in a collective, in a fund. So when you look on your portfolio and you see the fund and the value and all the rest of it, you might think it's not exciting, but you're participating in the global markets.
Yeah, no, I agree. Yeah, very well explained.
Right, number 5, take advantage of the engine that powers long-term investment returns, compounding.
Yeah, and I think compound growth, I think Albert Einstein said, compound growth is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it.
Yeah.
And I think compound growth is misunderstood by majority of the public, but by a lot of financial planners as well. And I kind of articulated to my clients of saying it's like planting a seed. We put the seed in the ground, we water it and we leave it, and nothing really happens. And I'm sorry to say that, listeners, but this is what happens when you start investing. You put some money in the market and arguably nothing really happens. 10% return on a small amount of money isn't that great or exciting. Over time, it starts growing. And then you start seeing these little shoots come through the ground. You think, oh, something's happening, but it's not that impressive. You're still going through the early stages. Not until the tree grows, you think, wow, I'm so glad I did that. And then you're seeing these 10% return on $1 million or so is quite exciting. But to get to that $1 million, you have to start early and start investing.
You do. Well, there's a Chinese proverb that we put in our investment brochure that says the best time to plant a tree was 20 years ago. The second best time is now. And so if you just get started and you contribute regularly, as you said, over time, it will grow. And just a return, when people say, 7% or 10%, on a small figure, it's not very much. But as you say, on a big figure, when you get to $1 million, it's huge. Yeah. And your money should theoretically double approximately every 10 years if you get the 7.2% return. So, it's get started, get regular payments paid in, and, just leave it alone.
No, absolutely. What's number 6, Paul?
Okay, number 6 is diversify and spread the risks within your portfolio using asset allocation models.
Yeah, so I agree with this. I do think some advisors diversify rather than diversify. Okay,
they hold too many funds.
Yeah, for the sake of holding funds, and they put fixed income in there because it's a different asset class, and they don't really need to. That was a Peter Lynch quote, by the way. I'm not trying to take credit for that. But all you really need to do to grow your portfolio is a globally diversified portfolio of equities. If you're not likely to spend that money in 5 years, that's all you need. If you're likely to spend your money in the next 5 years, then you need some short-term, up to 5 years, high-quality fixed income. But anything else is surplus to demand, really.
Yeah, and we know that fixed income is bonds, corporate bonds, government bonds. Lending monies to companies, lending monies to governments. And yeah, it's isn't it fascinating that it all boils down to something so incredibly simple, which is you could just do investing. You could participate as an investor by buying one fund on a cheap platform like Vanguard Investor if you just want simplicity and low cost. And people come to advisors largely to do a few extra things, to do the planning, to help with the tax and tax mitigation. And there are some technical aspects to it, of course, which is why we can help. But a lot of it's to do with behavior and encouraging clients to put money in and making sure you keep people on track. That's 70%, if not more, of the work that we do.
Or take money out. I'd argue 70% of the work I do is to get my clients to spend their money, to enjoy it. It's like, what is the point of dying with 3, 4, 5 million? There's no point.
Yeah.
There's no point. You want to help your children? Help them now. Let's start doing the planning together. And that's what financial planning is. It's not about just saving, accumulating, growing your wealth. Okay, that's straightforward if you can stay in your seat. I think for an accumulator, the planner adds value on keeping you in your seat during tough times. It's easy to say everything's great now. I was a planner, I'm sure you were too, in 2000 when the market's correct, 2007, during the pandemic. That's when we really add our value, and those things come around periodically. But really, let's just enjoy life. Let's just enjoy our wealth.
Yeah. Okay, but just one other thing on diversification. I think there are a lot of people that over-diversify. And just this month, we're including an article in our main newsletter, Tandem, which you can find on our website under the blog in Tandem. And it's to do with diversification and what diversification is and what it is not. So, for example, I've seen clients with portfolios of 35 funds, and I'm like, wow, you just don't need that. There's so much overlap. That's or clients with 4 or 5 pensions with 4 or 5 different providers. They're thinking that that's diversified, and that is not. That is just an admin nightmare. So you can put it all on one platform. Okay, let's move on. Number 7. Remember, risk and return are related. The higher the risk, the higher the likely return, and vice versa.
John, I like that, and I don't disagree with it. I don't like the word risk, if I'm honest. I would swap that out for volatility, because risk implies loss. And as you've already explained, loss is really when you crystallize a share price when it's gone down in value. But volatility, we talk to our clients about volatility, the ups and downs. The market is volatile. It goes up and down. It has a personality, and it's a bit wayward at times.
What can we call it, right? Because it's the FCA call it a risk profile, a risk profiling questionnaire. And I agree with you completely. I hate the word risk because it implies uncertainty and loss. But, should we just call it an investment questionnaire and say, do you want a high return or a low return? Which one do you want? And everyone goes, ooh, I want a high return. They're like, good. Par for the course for that is volatility, and you need to invest for 10 years.
So we don't ask our clients for a high return, low return. We ask our clients, are you investing for growth or preservation? Because some of our clients actually say, Warren, we just want to preserve what we got. We don't want to really grow this money.
But if they want to preserve what they've got, they need equities, because it's going to be the best buffer, if you like, against inflation long term. Bonds just don't do that. Bonds not for growth. They try to reduce volatility, as we know, which completely didn't happen over the last 3 years. They've done the opposite.
Short-term bonds have been okay. Short-term bonds, 3 to 5 years, they've done okay. I think the biggest fall on the short-term bond fund was about 3 or 4%. The challenge you've got is advisors putting clients into intermediate or long-term duration bonds. So
gilts are the ones fell.
Yeah. So as a listener, bonds are, like Paul's explained, loans to governments or companies. They come in different grades. So you have high quality, which generally is large companies or governments, and they also come in duration. So short term, i.e. the money's going to be paid back to the government within 5 years, intermediate 5 to 14, and then long term over 14 years. And as you go out in duration, you get more volatility. And the gilts can be short term, medium term, or long term, but it's the medium and long term ones that have fallen so much. So to dampen the volatility for a client who says, hey, Warren, you know what? This is a windfall. I've won the lottery. Okay. So we have a couple of lottery winners, won the lottery. Money's come in. I just don't ever want to lose this money. Now, it's not for me to say to them, they have to grow this money. I know it's the right thing for them, but it's like everything, isn't it? We didn't run straight away. We started walking, we crawled in, we got up on our feet. So to soften that volatility, short-term fixed income will do that job. They are not going to get the same return as a client in the 100% equity, but it meets what's important to them.
If you had, say, 10 million quid in the bank, it's a lot of money. You win the lottery. You theoretically, at the moment, given people's average spend, you could just leave it all in cash. If you don't want volatility, you could just leave it all in. I'm not saying you should, but if you did, the return is going to be so massive anyway. On 10 million quid, after tax, maybe it's £300,000, 25 grand a month. You could probably live on that.
I know, but trust me, Paul, clients can live to their means. I promise you. It's as their wealth increases. You can buy a couple of Ferraris a month. It's things happen very quickly. Trust me.
Right, rule eight. Recognize the importance of costs and tax that negatively affect the ultimate size of your wealth pot.
Yeah, no, absolutely. I think this is a huge one. And I think people underestimate it too. So it's really important to, on a cost perspective, to have a passive investment approach, or certainly if you're in active funds, a very low cost active fund. We wouldn't advocate that, but looking at the charges on your portfolio, making sure that they are low. But on a tax perspective, definitely prioritizing the likes of pensions, ISAs, offshore bonds over taxable GIAs, but sometimes your portfolio is so large that you need to include those. So being smart with capital gains tax realization and tax loss harvesting. So in other words, when your portfolio does go down, selling them, realizing the loss, buying into a mirror portfolio, so something very, very similar. So you can offset that loss in future against gains in future. So being very tax efficient in your approach.
These are all things that you can control. You can control the costs. You can control the tax mitigation to a large extent. And the thing is, you can't control the markets. And so if you remember all of these things, and you can control what you can, you're just going to have a higher probability of achieving your goals.
Yeah. Absolutely.
Okay, good. Number 9, hold your nerve. Keep short to medium-term market movements in perspective.
Yeah, no, I think this is exactly where a financial planner adds its most value. Ironically, I love listening to the financial news. I wouldn't advocate this to a listener if they're, because I can sit there objectively and think, you guys really don't know what you're talking about. And I know it sounds a little bit, egotistical, but they really thrive on short-term movements of stock market. They get excited when Cisco, I was watching the news the other day, Cisco's earnings came out and the share price popped up after earnings. They're excited by that. It means nothing. It means
Isn't
nothing.
it interesting, though, that in the news, the Negative Events World Service, which is all bad news, there's never anything in about good news. Rarely. Certainly about markets. Billions were added onto the market. It's always wiped off. So recently, our models and our clients have been pleasantly surprised recently because the markets have risen, and it's nice to show them that they go up. And it actually gives absolute, it reinforces the fact that you've got to stay in your seat and you've got to hold your nerve, because if you do, at the most unexpected times, markets rise, and then you benefit from that. If you try and do anything other than just stay in your seat, you're just going to make a mistake. Which takes us on nicely to point 10, which is don't try to time the market. This is rule 10. Yep. Don't try to time the market or cherry pick popular stocks or asset classes. Give me an example of someone who's done that yourself and unsuccessfully.
I can't necessarily give you an example of somebody who's done it, but you're right.
You've probably done it. We all have. You must have bought a stock once in your life and said, oh, that's a good idea to buy it. And it's gone the other way.
Yeah, of course. Of course I have. Yeah, but that's entertainment. That's not investing. So I have a portfolio of shares that I buy and sell because I enjoy it. It's entertaining. It's fun for me. So I'm not evangelical. Say you've got to put all this money this way and do that. But I will buy shares and sell shares but it's a small portfolio relative to my investment fund.
Yeah. So if clients want to do that, if anyone listening wants to do that, if it's maybe it's a maximum of 5% of your assets, that you put into a playpen, a fund where you might buy a few stocks because you want to participate, you want to have a go on trading 212 or eToro or something like that. But generally, your main platform that you might use or pension provider, we would encourage, I certainly would, low cost, index-based, evidence, well-diversified, global.
This is the thing. In my mind, we're talking about investing here. That doesn't even come to the equation.
Yes.
That's fun. That's enjoyment. Does that make sense? It's like when you're investing is investing. Yeah, absolutely. But let's not be, evangelical, say we can't do anything with our money. It's not all about growing. It's about having fun. We buy toys, and, we speculate.
Yeah.
Oh, what's number 11?
Just before we do, I got a quote from Peter Lynch who said about investing for the long term. He said, invest for the long haul, don't get too greedy and don't get too scared. It also said, and this one I think is from Warren Buffett, that the stock market is a device to transfer money from the impatient to the patient. Have you heard that one?
Yeah, no, I haven't, no, but that's a good one. Yeah, it's a very good one.
Yeah. Right, so Golden Rule 11, review and rebalance your portfolio at least annually.
Yeah, I don't agree with this one. I don't think you really need to review your portfolio, period. I think once it's set up, that's fine. Clients typically do review it annually, which is understandable. But to rebalance it annually by default, I think you're incurring friction, unnecessary trading costs. We have typically a sort of a strategic rebalance policy, which will mean if there's a capital gain or if the capital loss, we'll realize those for those reasons. Or if there's a tolerance break by about 10%. So in other words, if, for example, emerging markets have gone out of kilter, gone from, say, 9% to, say, maybe 11 or 12%, then we might rebalance then.
Yeah.
But we don't automatically rebalance. I know lots of advisors do, but it's not something we do.
Well, let me tell you why it's one of our golden rules, and that is because not only is it a compliance requirement for us to provide the client with at least an annual report and a review of their portfolio, but we do so to also confirm suitability annually, confirm that the risk profile that they're in is still appropriate, and we also rebalance annually as to prop up the cash back to 2% because advisor and platform charges come out of the cash. So we've got over 300 clients. We've got to make sure that we do it annually so that they don't just sell on the last fund that they bought. And so it's what I believe is the best thing for us. But there are statistics that show that you might be better off doing it every 5 years or so, every time it's 10% out, so that you benefit from the increase of global equities over time rather than just sell them when they've gone up a bit. But anyway, it's worked for us annually.
Rebalancing is a real unusual thing to think about, because if you think about it, what you're doing is you're typically selling your winners. And from an entrepreneur perspective, that's a really odd thing to do. This fund's doing really well. Why do I want to sell it?
But you're locking in gains and you're minimizing losses is the way I see it. And so again, it's horses for courses. That horrible phrase. Yeah. So it's one of my golden rules. Yeah.
What's number 12?
Number 12 is discipline. Also requires regular monthly investments to benefit from pound cost averaging.
Yeah. No, I agree with that. And
do you get a lot of your clients to pay in regularly? Do you encourage that?
If I'm honest, I think we've mentioned this before. Most of our clients are financially independent. Okay, so they're financially free. They now rely on their capital. They've either sold a business, they've come into some inheritance, they've won the lottery, whatever it might be, and they've retired. It doesn't mean they're old. Our average age is 56, but they now live off their capital. But for those clients that are in accumulation stage, so they are building up, and this typically goes for the children of our clients. We very much advocate to look after the children. We work on a 50-30-20 principle. So 50% of their money goes to run their household bills, 30% of the money goes to their variable spending expenses, and then 20% of their money is invested or saved, depending on where they are on their pipeline. So we do advocate pound cost averaging, investing monthly, but it is for the children maybe of our clients rather than our clients.
I would say that the majority of my clients are paying regular premiums, and I encourage it. And that my rule of 3 is regular premiums and lump sums. You have to put money in. Time, you have to give it time. It's time in the market, not timing the market. And 3 is just the discipline. I mean, that's a breakdown of these sort of rules, but I've seen it all with clients where they've started with a very small pot of money. They've been getting going in their 30s and they're paying into their ISAs and pensions. And as you say, over time, it's with clients, sometimes it's been 15 years plus that I've worked with them. They've built their pot up to £500,000 million through regular premiums alone and the compounding effect over time. So it's an incredibly powerful thing. You do need to understand that you have to start, you have to get to the point where you start and then keep it going. And if you do, over time, it'll make money.
I don't disagree with you. I completely agree with you. Ollie, my son's 19. He's just about to start a work apprenticeship in September. I've already had the conversation with him about, compounding growth and regular contributions into the investments. Completely. So
okay, we've got a different format now. We've talked about the focal point there. I think we gave it a good go talking about the 12 golden rules. I want to mention a couple of things, a couple of quotes, but also a book that I want to recommend. Can we do that?
Yeah, sure. Go ahead. Fire away.
Okay. I've been thinking recently about what it is that I do with my time, and I talk to clients about what they do with theirs. So the book I want to recommend to everybody is Oliver Burkeman's 4,000 Weeks. And it is fascinating. He reminds you in the book that life is just not a dress rehearsal and that you've got to make the most of it. You've got to live your best life. And I just think, wow, I advocate that. I love that. But he also talks about how busy people are and how with the onset of social media, with the onset of technological advances, and how there are lots of life hacks, which he doesn't like that expression, but things to make things quicker, whether it's software or a gizmo or something. And then people become more and more efficient, but they cram more into their lives. And it's just overwhelming. And he gave this example of back in the medieval times when before there were even clocks and people would go out and live, get up with the sunrise and go to bed at dusk. Right? Dusk and dawn. Yeah, dusk. And their perception of time was very different. And now we sort of try. A lot of people don't meditate. They don't take time out for themselves. They're so busy, on the treadmill, that they just are letting life pass them by. So it's a fascinating book to talk about time management for the mortals.
Yeah. I like that. That would be good. I might even pick it up myself. But no, definitely. The only quote I would probably say today would be, focus on what you want and not what you fear. I think so many people don't focus on their outcome, what it is they really want, and they focus on what can go wrong. I'm doing that way. So take that away from this week.
So I got one quote, because, I always put like 50 quotes in and then we elongate this podcast. But one quote, which is actually from Jack Bogle, who is the founder of Vanguard. And he said, owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. And he was referring largely to Charlie Ellis's book, Winning the Loser's Game, which is a tremendous read. But you've got to be in it for the long haul. You've got to be in it to win it. Yeah. Nothing in this game for two in a bed. Don't know what that means. There's a reference to Bullseye there. That was tremendous.
Oh, was it? I thought you said two in the bed.
Two in our bed. Yeah. Playing darts.
Now that is a good thing.
So 12 golden rules, and all those things will be in the show notes. It's various links and things that we've mentioned, so do check those out. Warren, we're going to wrap up?
Let's wrap it up. Okay, thanks for that, Paul. It's been a great day today. Enjoying going through your 12 golden rules and have learned some things, which is fantastic. If you've enjoyed the show, please like, share, and subscribe to the show. Let us know any questions that you might have. We do respond to all of them. And until next time, see you again.
Thank you. Bye now.
Thank you for joining us for today's discussion. If you're enjoying this show, please subscribe to our podcast. It's a great way to support us. If you have questions or comments about this podcast or topics you'd like to suggest for the show, please put these in the comments section on YouTube. Remember, if you find yourself humming a theme song for the next week, it's not a sign of brainwashing, it's just a testament to our awesomeness. Or possibly a mild earworm. Consult a doctor if symptoms persist. If this show is designed to be informational only and does not constitute investment or financial advice, please contact a regulated financial advisor before taking any specific action.